Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, markets were pretty flat yesterday. It was Easter Monday after all. They did recover from early losses. We had a reaction to non-farm payrolls. Yields were a bit higher. Markets didn't like that initially, but then we did recover as we saw signs that the banking crisis might be easing, and that helped fuel the move back up. Metals did give up some gains. Gold small down, silver not doing a lot, and copper down also. And then oil also drifting slightly, had a really good week, obviously last week, is managing to hold above that gap right now. And nat gas had a strong bounce, obviously has been very, very weak lately, but it managed a 7% bounce yesterday. Looking at vols, trickling higher in the US. Obviously, European markets were still shut. Now, obviously, we've got more event risk coming with the macro data. We've got obviously CPI on Wednesday, and then we've got earnings season starting as well. Banks starting to report on Friday. So market is starting to price in a little bit more action going forward. Most commodity vols were pretty muted. We did see GDX higher and nat gas softer. Looking at carry, sea of green, saying that implied vols look expensive versus realized. Again, wouldn't read too much into that just because now implieds are looking forward. Realized is now capturing the Easter period that was quiet. So there's this discrepancy. So it's going to make all vol look expensive. But remember, implied vol is forward looking and it's anticipating more movement than we have seen lately. So this would not be a signal or not a clear signal to go and sell a load of gamma because all the carry is positive. Okay, so you need to understand the nuance within the carry to know that and not just blindly follow it. And then in fact, we've actually been covering some short vol positions because, you know, we do think the market might start moving around again, and we kind of made that short vol call correct, and so we're quite happy to bank some profit on that. There was a slight uptick in skew, about half a vol higher, S&P and Nasdaq there. Now back to the 30th percentile if we look across most of the equity skew, which is a slight premium to where we were at the start of the year, and that makes sense, right? Clearly a bit more downside tail risk now being reflected by markets, and that's not overly surprising. Precious metal skew slightly higher as well for puts. Obviously, that's been very firmly for calls, but the rally has seemed to sort of stall again around this 2,000 area on gold. And then nat gas skew is still very elevated in the 96th percentile, as that thing just has not been able to catch any kind of bid. Looking at some charts, the question really for me is when will lower earnings matter for stocks? Okay, so Jefferies put out a good bit of research here showing the year-on-year EPS growth, and that is expected to turn negative. Okay, and the question there is, that's expected now. So if it is negative, should that move the market? How much of that is already priced in? Okay, now they look back at when the earnings growth has been negative, and they found that when it's in the -5 to 10% range, which is kind of what it's expected to be this time round, that's when the forward-looking performance of the S&P has actually been the worst. Okay, so going forward, one quarter on average, it's been -6%, 2 quarters -9%, 4 quarters -12%. So the idea being that a moderate earnings compression is actually the worst thing for stocks. If you've got a really bad earnings compression, actually you've historically seen stocks higher. Now, the only way I can really rationalize that is if it's that bad, that's more likely to trigger a stronger policy response. So then equities end up bouncing quite hard out of it, even though they had a really bad sort of earnings derating. Okay, so that's just something to be aware of. And then you've also got Hartnett talking about PMIs heading below 45, plus earnings weaker pretty much always equals recession, and we should then expect non-farm payrolls to print negative. Okay, so this is non-farm payrolls in the light blue. This is ISM manufacturing PMI in the dark blue. So in theory, this swing lower, if it continues to head this way, it should take the jobs market with it. Clearly, non-farm payrolls has been quite sticky, hasn't moved yet. But this seems to be what the bond market is pricing in, right? The bond market seems to get the memo. Equities, not so much. So when will equities actually wake up to this idea that the bond market is saying, well, recession is pretty much a done deal? We'll see. And we'll see if it matters to stocks. But for now, recession being priced by the bond market has been met with a big rotation into tech and mega cap tech especially, and that has basically held the market up quite well. Okay. All right. What else am I thinking? Now, I've been looking at TLT. Obviously, been long bonds. Those of you who subscribe to our overlay portfolio will know that we've had some call spreads in there. We've been trading around them. They've done reasonably well. But if you look at the 30-year yield chart here, that's what I brought up. You can see this is very, very corrective price action that we've had. And that, for those who look at Elliott wave, that looks very much like a fourth wave. Because if we say from this bottoming point here in 2020, if that was a 1, that's a corrective 2, that's an impulsive 3, that's a corrective 4, then we should be expecting a fifth wave rally at some point to complete this move. Okay, that's what the Elliott wave people would be saying. So the question is, are we going to get one final spike in long end yields to complete the move, right? I don't know. Markets don't seem to be pointing that way right now. Everyone's talking about recession, but we've got inflation data out coming on Wednesday. We've got the FOMC meetings that are due, and they seem to think they're holding rates up here for a while. You know, is there going to be enough data to let yields have another little go at the upside, right? And that's the risk that no one really seems to be pricing right now. We've also got the debt ceiling to contend with over the summer, which might lead to more bond market weakness and issuance, etc. Many of the investors have obviously flocked into fixed income in recent weeks. Similar to us, our base case is to own bonds, but we do think if you can own some cheap tails for the unexpected outcome of a spike in bond yields, then that might be worth parking some of that risk in the book just in case. So that's what we're looking for. So then if we look at our dashboard, you know, the big standout thing on TLT is that the skew has flipped. So typically the skew was a bit higher, let's say 2 vols for puts. It's now flipped to close to 1 vol for calls, okay? Because as the bond market has kind of rallied, people are now thinking bonds are going to keep spiking, yields have effectively turned, okay? So, you know, the strategy compass, I wouldn't say we're doing too much with what that's saying. That's quite near the middle. But you can see here this quite dramatic move down in volatility. So implied volatility is now approaching cheapish levels. We've got a fairly flat term structure here. We've got skew for calls, which means put skew is cheap, but we've got positive vol carry, which means we don't just want to go and buy a load of puts necessarily, because the decay bill may well eat us up and those things will evaporate in value and we won't make any money out of them. So what do? So the trade I'm looking at is a put ratio where we sell the 25 delta puts. All right, that's it for today. Cheers for listening. Catch you all tomorrow.